Welcome to the Car Wash Advisory Podcast, your trusted source for stories, strategies, and insights from some of the most influential leaders in the industry. Let's dive in.
Hello, everybody, and welcome to the Car Wash Advisory Podcast. Today, we have a very special guest, being that of Richard Harmon, focused on the ESOP type transactions. And we couldn't be more excited to have you, Richard. So thanks so much for joining us.
Harry, thanks for inviting me. It's a pleasure to be here.
Absolutely. And we have a lot to discuss here because until recently, and until you and I became acquaintances and friends, I couldn't for the life of me digest or wrap my head around this whole thing of ESOPs. But maybe before we jump right in there, you can give a bit of a background on yourself, CSG as a firm, and tell the listeners sort of a bit about yourself.
Sure. I'll just give you kind of a brief thumbnail sketch. Back in the day, I've been a CPA for 40 years. I call myself a recovering CPA. I haven't practiced public accounting since the 80s, just to date myself. And along the way, I became a financial systems gun. I would build financial systems from Main Street to Wall Street. And in the 90s, built a company to about 500 programmers who were doing assignments on all the Fortune 500 companies, and sold that company to company, went public, started a bunch of small businesses. And one was a financial staffing business. So I did CFO, controller, bookkeeping work, initially Silicon Alley, New York-based technology companies, but then we broadened it. And then I got to 2007 and the Great Recession starts kicking in and my market's collapsing. I'm losing like 70% of my revenues. And I dusted off my CPA certificate and sharpened my pencil and took one of my own assignments as the CFO of an ESOP is Employee Stock Ownership Plan, owned manufacturing company in New York. It's a company called Pauling Corporation. And Pauling had started in the 40s. They used to do the seals, the rubber seals on ammunition cases. And they expanded over the decades. It's really talk about company town. The company's named after Pauling Corp. It was the biggest employer in town, et cetera. And the CFO had been there 27 years, was retiring. And I knew somebody on the board, and I ended up taking that CFO position. And there were two factories. There were 400 employees. They were third generation. We're running the two factories, two cousins. And I began to learn a lot about employee stock ownership plans. Now, this was a plan that was seasoned. It had started in the 90s, the second generation used the ESOP to get liquidity and financial diversification. But now we were in the third generation. And most of the employees had been in retirement status. And the impact on those retired employees was incredible. I mean, these are people making, back in the 2000s, $15 on the line, and they're getting these great retirement benefits through the plan. By happenstance, and this is kind of the end of that story, Larry Kaplan, who's the founder of CSG Partners, nation's leading ESOP investment bank, was playing golf with the audit partner of Pauling. And Larry said to that guy, this guy, Luke Eversold was his name, he said, hey, who do you know who can do due diligence for all our transactions in the tri-state area? You should talk to Richard and his back office company. So we had a conversation. And next week, I just finished out my 14th year with CSG as a managing director. And it's been my joy to have completed a couple $1 billion in transactions, several dozen transactions. And I'm just thrilled that you and I got to chat a few weeks ago. And it was one of my favorite conversations I've had in a long time. A, you have so much energy. And B, we went on for hours because you were just layering everything that I do in line with everything that you do. And I'm, again, thrilled that it resulted in this call today.
I assure you the feeling is mutual. I'm so glad we met, Richard, and I'm so excited to bring everything that you know and everything you can do to this space. So as the listeners know, anybody listening to this, it's not the case that all these car wash companies that have built such successful businesses should necessarily sell to a third party. And this alluring yet seemingly complicated transaction type of ESOPs is so very difficult admittedly for me as well as anybody else to decipher when standing from the sideline without having somebody as smart and well versed as you are in it. So I guess for everybody, maybe we can frame sort of what the heck is an ESOP, why do it, and what's going on here from a high level.
So, the brief history of an ESOP is there was a gentleman in the 50s, Louis Kelso, and he wrote a book called The Capitalist Manifesto, literally his answer to the Communist Manifesto. And his, which is, he opined the underpinnings of ESOPs, which is America's a capitalist society, wealth is concentrated. How do we inspire owners to share equity with their employees? Because the more people that we have invested in capitalism, the stronger the republic, right? And so from the 50s all the way through the early 70s, he was able to get that into Congress. And when Congress passed the Employer Retirement Income Services Act of 1974, ERISA for short, when they passed ERISA in 74, it created three things. It created IRAs, it created 401ks, and it created an employee stock ownership plan, which was a methodology where an owner could sell a stake in their business to a retirement trust that would benefit for their employees. So 10 years after that, to continue the history lesson, so in 74, we had the passage of ERISA and the first ESOPs. In 84, Congress expanded that benefit. They wanted to come up with more reason to inspire owners to sell a stake. So they came up with something called a 1042 rollover provision. For those of you familiar with real estate, it's like a 1031 exchange, except for it's much broader. You have a full year if you sell 30% or more to this retirement trust. You have a full year to reinvest your proceeds in what's called qualified replacement property, which is defined as stocks and bonds of U.S. operating companies, actively managed real estate. You're not allowed to do munis, treasuries, passive things, because Congress said, hey, we're going to give the owners this benefit, but we want it to juice the economy on the side. So they wanted you to reinvest in U.S. operating companies. Most people, if they sell their company, they're going to spend about 30% on capital gains taxes to whatever state they're in, plus the IRS. And so here you've got that opportunity to put that money to work for you. So that was in 84. And then in 98, for tax year starting in 99, Congress made another shift. There was some lobbying going on. ESOPs had somewhat fallen out of favor because LLCs and S corps were very popular, and there was one level of taxation. And if you did an ESOP from 74 all the way through 98, you had to be a C corporation. And while there's tax benefits to doing an ESOP, because a whole transaction deductible, while you're a C corporation, so you don't pay taxes for a number of years after you do an ESOP transaction, you end up becoming a tax-paying C corporation forever. So to reignite interest around ESOPs, Congress passed this legislation that allowed you to become 100% S Corp ESOP starting in January 199. So to dial it into a big picture, there were some very large ESOPs by this point. 100 million in profits, paying 40 million in taxes a year. Literally, that C Corp could elect S Corp as of January 1, and the K1, instead of going to individuals, because now there's K1, it goes to the retirement trust. The retirement trust does not pay federal or state taxes, with a couple of exceptions. And so literally that company became tax-free in perpetuity. So you have a U.S. operating company that's tax-free in perpetuity. And the IRS was a little bit apoplectic. They said, and there were hearings that went on for 2 or 3 years. How can this be? How can Harry's car wash, netting $5 million a year, paying 40% taxes, compete against my car wash? I'm making $5 million a year and I'm not paying any estimated taxes. And Congress said, well, it serves the greater good. And so we've had this 100% S Corp ESOP now for 26 years and counting. And that was a game changer. And then there was one other piece of information, which is kind of complicated and tough to unpack, where in 2004, the IRS came out with a Reg 409P, which allowed the selling shareholder, or anyone actually, to retain a stake in 100% S Corp ESOP disregarded for tax purposes. So you could end up with warrants or options or stock appreciation rights, the rights to buy back equity in that 100% S Corp ESOP, but they're disregarded for tax purposes. So you can have up to 49% what's called synthetic equity in an S Corp ESOP disregarded for tax purposes. Wow. So ESOP started as a defined contribution pension plan, like a 401k and an IRA, and it evolved to a full-blown corporate finance transaction with these little events that I just described, to the point it became a tax-enhanced leverage buyout of your own business, where you can literally put leverage on your company. You can defer all your capital gains by selling a stake to the ESOP, 30% or more. You can get to the point where you'll sell a majority of shares to the ESOP trust. You'll redeem another chunk of equity for warrants, and the company can become tax-free in perpetuity. And when you put all that together, it allows, here's we should frame this part. The owner gets liquidity, they get diversification. Most owners of privately held businesses have 80% of their net worth tied up. This allows them to get money outside working for them independently, so that no matter what happens to the business, they've got outside investments. The company gets to deduct the whole transaction. The employees end up with this stake that becomes valuable over time. And then what are the other moving parts, right? So you need to sell 30% or more to be able to defer all your gains. That's one thing. So we almost never do a transaction less than 30%. A lot of times we'll sell 30 to 49%. And then we'll step up to get you to probably 75% or so on a second transaction a few years later. So at that point, you've harvested 75% of the enterprise value. And then we'll have you redeem that remaining equity for a good chunk of warrants, often 40% warrants, and the company will become tax-free. The company itself gets to deduct the first transaction, the second transaction, so it stays very tax efficient, and then it becomes tax-free. And then the owner gets the first bite of the apple, the second bite of the apple, and then those warrants in the outer years become very valuable because the company is accumulating excess cash because it's not being drained on a quarterly basis of estimates. So that's a lot to unpack. I'll take a big breath right now.
No, so this is why it's so very exciting. So we'll get to the impacts and the effects, which you've been teaching me so very much about, and which at first glance, I think it's fair to say, and nobody would hold it against you if you were thinking to yourself, this has got to be a joke. It's too good to be true, right? We're talking about turning an entity into perpetually owing no taxes, the owner being able to take proceeds out and not pay taxes on that, and you're rewarding your employees all while doing this.
Yes,
So,
yes.
But before getting into that, you mentioned something that I think most people, at least I did, I struggled so much with, which is, why is the government encouraging this? And that timeline you gave was fantastic, because it seems, and you tell me if I'm off here, it seems like the government's doing more and more and more to try to incentivize these. Why? You say it serves the greater purpose. Why does the government want more ESOPs?
Both sides of the aisle have embraced ESOPs from the beginning. Republicans love owners getting liquidity and diversification on a tax advantage basis and still retaining governance. So we'll get into governance in a bit, likely. Democrats love the idea of employee ownership and employee stakeholders. And so it's been aligned on both sides of the aisle. What's happened with ESOPs is during the Great Recession, they laid off a third less people. There's more engagement. ESOP companies outgrow their peers by 3% or more per year. Sometimes I wonder whether it's the tax benefits that drive that, or it's the employee engagement. I suspect it's a combination of both. And that's what it's been. In the industry, initially from 74 all the way through the early 2000s, the ESOP advisors were mostly ERISA attorneys. pension plan attorneys just putting documents in place. And when we got involved, when some of these other elements came into being, we realized, oh my gosh, it's a tax enhanced leverage buyout of your own business. We can put leverage on the company. You end up continuing to govern the company. You have upside. Our claim to fame these days is we raise more capital with no personal guarantees to finance these transactions than all other advisors. So at some point we'll say, hey, let's sell 30 to 49%, and we'll do an analysis. We'll say, look at what you're going to do over the next 5 or 10 years. Here's the growth you expect. Here's all the taxes you're going to pay, and then we'll show you one of 400 flavors, or one or two 400 flavors of an ESOP to dial in what makes the most sense for you. And we'll show you how much of those tax dollars we can repurpose for you to get liquidity and diversification as the selling shareholder, what it does for the company, and then what it does for your employees. And I think those powerful impacts have just resonated. It's very few issues that resonate on both sides of the aisle, as you can imagine.
So this makes sense to me, but then there's the part, and that's very helpful to understand. But remind me again, and everybody who's listening, why is the government encouraging companies to go into a form or a structure where they don't pay taxes to the government anymore?
I think it was some successful lobbying effort, just saying, we should allow these S Corp ESOPs, and maybe initially not thinking it through. And afterwards, again, there were debates in Congress that went on for 3 years. One time I was talking with a partner of one of the big firms who was in those hearings, testifying. And they just came down on the fact that, over the many decades, wealth is getting more and more concentrated. And if you don't have a mechanism for employees to benefit, you're gutting the middle class. And what I've seen is the owners I work with are already abundant. They're already very successful folks, but they get liquidity, they get diversification, and then they create this benefit for their team. And once in a while, I'll have a transaction where we'll do an ESOP, and 3, 4, 5 years later, they'll sell to private equity or third party. The owner will the selling shareholder will end up with more cash than they would if they didn't do this first, because they didn't have to pay tax on all the money they took out. And the employees will end up with stake they never would have had. When I sold my technology staffing company in the 90s, and they went public, we bonused our managers. I don't think we went down to the line level, maybe some minor bonuses. But I've had circumstances where, an owner said to me, hey, I made millions more doing the ESOP first prior to having my final exit. And then when I did the final exit, my employees got 5 times their annual salary into their 401k, and I netted millions more. And that was just that's just the win-win outcome. Now, go ahead.
Go ahead. Well, I was going to say, so is it fair to say the government's okay with this, and they're okay creating entities that they're not collecting otherwise corporate tax that they would be getting, because they're, one, redistributing wealth appropriately to the middle class and to the employees who are well-deserved, rather than keeping it concentrated. And then secondarily, there's this sort of, albeit less tangible argument here, measurable, that doing this structure and rewarding your employees actually results in stronger U.S. companies.
Correct. Both of those are, but there is a kicker here, right? Because the IRS, what are they doing? They're giving up near-term capital gains income, right? Which creates this benefit for the employees. When the employees are allocated these shares, they don't pay for them, so they don't have any basis in them. And when they hit retirement milestones, or if the company sold, the company will make a market for their shares at whatever the market value is in the future, right? So what does that mean? Right now I have a client where it's a very successful company, and particular employees who've been there 10 years or more have $1 million or more in their ESOP accounts. And if you're 55 years or older, you get the opportunity, if you've been in the plan 10 years, to sell 25% of your stake. So one of my friends just came up to me and said, hey, I just got to sell 25% stake, which in their case was worth $360,000. That $360,000 goes into their IRA or 401k, where they can keep deferring it But when they retire and they pull that money out, they pay ordinary income on it. So here's the closing loop where the IRS is still kind of good with it, because at the end of the day, they get long-term appreciated ordinary income as opposed to near-term capital gains taxes. So that's where it balances out. On the tail end, when the employees are pulling out the money from the retirement accounts, paying that ordinary income in the retirement years, that's where the economic equation pays back the system a little bit.
But here's the thing, Richard, just to be super clear there, because there's so much going on here and you're such a wealth of knowledge and you know all the intricacies. Just to be clear on that last point, because if taken out of context, it almost sounds like a negative, right? Because you're saying, hey, guess what? This money that the employees are putting in their IRAs or retirement funds, they're going to have to pay ordinary income tax, which they otherwise wouldn't have to have paid. Great. But it's money they would have otherwise not had.
It's a huge, huge thing. If I'm going to give you a $500,000, Harry, and you got to pay ordinary income on it, or I give you zero.
Right. Yeah. That's what I want to make sure we're all clear on.
Right.
It's still incrementally incredibly valuable.
And statistically, employees end up with about 4 times the value in ESOP companies than they do if they just have 401k investments and the like. So it's very powerful for them. And I got to see it firsthand back at Pauling Corp, back in the day. And yeah, it's just been, so what I love about it is, again, the owners I work with, they're already abundant. They're already successful. They're typically making, low, mid 7 figures. Sometimes they're making high 8 figures, in terms of profits on a yearly basis. But it creates this wonderful trail of gold for the employees. I always like to tell owners to caution their employees, it's an opportunity, not a promise. The company needs to be valuable in those future years. Once you do an ESOP, there's an independent valuation every year, and the employees receive a statement, and they're allocated shares over a long period of time. Here's how many shares you're allocated, which is based on your W-2 salary relative to the other employees. Here's how many shares you're vested in. You vest over 6 years typically. Here's 2 through 6, 20% a year. You can also do cliff vesting, but almost nobody does after 3 years. And here's the value per share. And so after they get vested, typically the first few years, the company's paying down the debt to the selling shareholders in the bank for the transaction. But after about year 3, they start to see a real hockey stick in their statements. But the company needs to be valuable when it comes time to sell. Well, the good news is, once you get to be 100% S Corp ESOP, even if you're in a non-tax, a state that doesn't have tax like Texas or Florida, you're still saving 37% a year in cash flow that would go to taxes that can be used for working capital, for expansion, for all these things. So you've got a lot of extra horsepower. You've got a lot of extra rocket fuel to stay successful in the future. And so that's the world I jumped into, and it's just been wonderful. And part of why it's wonderful for me is our team just executes at such a high level. The way we write the financial memorandums, the way we do our analysis, the success in our capital raise process. We run a competitive auction to raise capital. Our structuring, we've just been swimming in this pool for over 20 years now. The company's been in place since 2000. We were a middle market investment bank affiliated of American Express, and we rolled out and started in 2000, rolled out in 2002, and then kind of repositioned ourselves as these seminal changes hit in the ESOP space. And we've done some $25 billion in these transactions right now. We have typically we'll close 20 to 25 a year. In 2024, we closed 30. By the end of 2025, we'll have hit 40 this year. It's been quite something.
I've been remarkably impressed. And for anybody who knows me personally or has listened to my stuff, you probably realize I'm not the brightest person in the world, and I'm kind of dense.
You're pretty bright, Harry.
I have not been able to no, I have been avoiding. I appreciate the compliment, although I don't know if it's true. But you were able to explain this to me in a manner where it's very hard to understand this without somebody who lives and breathes that. I am positive of that. But I want to make sure that because I am furiously taking notes to make sure that I try to stay somewhat organized because there's a bazillion things we have to cover here. I want to make sure that we recap or at least go through. So we've kind of gone through why the government allows it. That makes sense to me. The primary benefits, here's what I've got, Richard, and you let me know what I'm missing. One is your corporation no longer pays taxes, right? Two is you get to reward your employees via the plan. And we'll get through the mechanics as to maybe some of the initial trepidation or issues somebody could have with maybe do all employees get, we'll go through that. But your employees get paid and they get a vested interest in the company. Your company no longer pays taxes. You get cash out today that you don't have to pay taxes on if you use it for certain means. And then additionally, and we'll go through this next, maybe the common sort of pitfalls or potential pitfalls that somebody says, all right, well, what's the catch? And I think we can maybe go through some of those. Am I missing any of the primary benefits that this provides?
Well, I would say no tax. Once in a while, I'll have a client become 100% tax-free immediately. And if they're a C Corp and they close their transaction and then elect S Corp the next January 1, that's a very short path to becoming tax-free. If they're an LLC, taxed as an LLC, a lot of LLCs these days are taxed as S Corps. If you're an LLC taxed as an LLC partnership, you can do what's called 351 exchange, tax-free exchange. You can close your ESOP as a C corporation, and then any January 1 subsequent to that, you can elect S Corp and become tax-free. Now, if you're an S Corp and you close your ESOP as an S Corp, you pay capital gains taxes. Why? Because when they created the 1042, there were only C Corps around. And the 1042 regs are tied to you being a C Corp. And if you are an S Corp, in most cases, it makes sense to close as a C Corp. Why? Because you're not going to pay hardly any taxes at all after your first ESOP transaction for a few years, and then you do a second ESOP transaction. And then after you've taken this money off the table and deferred all your gains, then you'll re-elect S corporation. But if you're S and you close as a C in order to defer your gains, you have to wait 5 tax years to get back to S. So if you're a C, you can get right to S. If you're an LLC, you can go LLC to C to S. But if you're an S corp, in order to get that benefit, you close as a C. So once in a while, I'll have a client. They'll say, "Hey, Richard, I'm in Florida. I'm only going to pay 20 or 23.8% capital gains. I'm just going to become 100% S corp immediately." We do that analysis. We say, "Okay, that may make sense on paper, but look at how much tax that you're paying that you don't need to pay." So my point is, when you close as a C corporation, you get to deduct the entire transaction. If you sell 10 million to the trust or 20 million or 50 million to the trust, you get that amount in tax deductions. So typically you're not paying taxes for several years or paying very little taxes while you're a C Corp, but you're not tax-free. You're paying a little bit of taxes until I get you to that 100% S, and then you're tax-free. So to point number one, it's not no tax right away, although it can be. Actually, it can't be, because you'll end up paying capital gains if you just become 100% S Corp ESOP. Just last, I've been traveling a bunch, but so I guess it was 3 weeks ago, I was in Arizona. I was presenting to a company, and I said, "Guys, you're going to pay $50 million in taxes over the next 10 years. By the time we were done with our analysis, they were an S Corp, closing them as a C and then getting them back to S and then becoming tax-free. They were paying $3 million in tax. So we took $50 million down to $3 million. And we do that all the time.
Richard, let me ask you one thing. So here's where I'm beating up ESOPs right now, right? Because it's so hard to conceive the magnitude of benefit, and it seems so ludicrous that this kind of transaction is allowed. So let me ask you this. Immediately, what comes to my mind from a sort of naivety-based vantage point? Okay, but certainly those are temporary benefits. Is it accelerated depreciation type mechanics where I'll use it all up and then I go back to normal? Am I paying the pipe for?
Well, back in the day when there were only C Corps, you had to be a C Corp if you're an ESOP. You couldn't you couldn't shift to an LLC or an S. You had to remain a C corp. Back then, let's say you're making 2 million a year and you're selling 10 million to the ESOP trust, right? Well, you're not going to pay taxes for 5 years, but now you're a tax-paying C corp. Year 6 in the future, forever, right?
Right.
That went away when they came up with the 100% S corp ESOP situation. So it's not a temporary benefit. I think what you need to do though is you kind of surf the structures, right? So we look at whatever structure you are. So if you're in an LLC, it's taxed as a partnership, you're in a catbird seat because we can close you as a C, and the very next January 1, you can become tax-free. I'm not going to get into the weeds as to why, even when we have that opportunity, we might have you wait an extra year or two. It's not worth getting into. But, I'm kind of considering myself at this stage to be an ESOP evangelist because so many owners never hear about this option. And the reason I think they never hear about the option is everyone who's in the investment banking space, everybody who's doing M&A or selling you to a third party, we all get greater fees, including us, because we do some of that work. We all get more money if we sell you to a third party. So think you've got this beautiful house, it's worth $10 million. And if I use this real estate agent, I'm going to make 6%. I'm going to get a $600,000 commission, which I'm going to split however I'm going to split. However, if I do this ESOP thing, maybe I'm going to get 200,000 and then we're going to split that. And so it's just not interesting. We found, and we go up against private equity constantly. We'll do a compare and contrast. We'll say, hey, here's how much you're going to end up after tax. And typically doing an ESOP transaction, you'll end up with a couple of additional turns. So if you're selling at 6x, you need to hit 8x with private equity to net the same 6. I've had one recently where the ESOP was at 10x and private equity would have to hit 14x. We'll talk about this in a little bit. I think what determines value in this process, Congress said to these ESOP trustees, these institutional trustees, which there's not all that many of them. There's about 10 at the moment that are institutional trustees that just specialize that. Congress said to that trustee, you're allowed to buy shares for the trust on behalf of the employees. Do not pay more than fair market value. Do not pay more than fair market value for the shares. So there's a whole belt and suspenders process in place to make sure you're not paying more, because if the shares are worth 10 million and you sell them for 20, you've just taken advantage of your employees.
Sure.
And so there's a whole process there. But what does that mean? It means that an ESOP is a financial buyer. Typical private equity transaction is a financial buyer. If you're in an industry, often software as a service, things like that, and car washes straddles the line, right? It straddles the line. There are, so what line does it straddle? When you have a strategic buyer, right, who's going to pay, as it's happened in the car wash space a couple of years ago, 22x, right? Not a good ESOP transaction, because even after you pay all your taxes, that trustee is going to be able to pay what a financial buyer would pay, which in your space is 10 or more EBITDA, but it's not 22. So when we have a company that think about when Google/Alphabet bought YouTube. It was a strategic acquisition. It had no profits and they paid $1 billion for it, right? Most companies in America sell as a function of their discounted cash flow, which is the present value of their future earnings stream, or based on comps, private and public comps. And so we run that whole process. But typically, whenever there's a normal PE buyer, we crush it. What's the trick? A lot of times we're selling 30 to 49% initially. And we want the owner to have enough capital so they can reinvest that, and then we'll step them up again. If they're selling to private equity, they're selling 75%, 80%, sometimes 60%, they have to roll the rest. They're getting more they're getting a bigger check at closing, but they're paying capital gains on that check. So when I've got an owner who's got a runway of, let's say, 3 to 5 years, they're going to harvest a lot more money after tax going the ESOP path than just stroking that check to private equity. And I'll give you one example of that. I've worked with so many entrepreneurs back in the days. I was with Coopers and Lybrand, now PricewaterhouseCoopers. I was the founding member of the Emerging Services Business Group, and I ended up doing consulting for all kinds of companies. And of course, that continued when I was building financial systems for so many companies. And the idea is, it's really hard to be a successful entrepreneur. Nobody knows, who has not sat in that seat, how many decisions have to be made on a yearly basis. It's at least 5,000, 10,000 decisions. 2/3 of those have to be right for you to be able to stay in business. You're dealing with, competition. You're dealing with all kinds of regulatory matters, et cetera, et cetera. And I just really have an appreciation for entrepreneurs. So I had a friend of mine who had a business in California that's worth $50 million. And his buyer said, well, we'll give you $30 million at closing, and we're going to have you roll 40%, and you're going to become plugged into this platform company. We've already got 3 other companies like you. And we think that your 40% you're going to roll with us is going to be worth, multiples of increased value in the next 3 or 4 years. To which I said to them, I said, look, if they really thought it was going to be worth multiples, they wouldn't have you roll 40%. They would have you roll 5%, because they would want all that upside for themselves. Anyway, so bring it all home. In this particular business, the person had been running it for decades, was at a kind of retirement milestone, on the cusp of 70. And I said to him, I said, so what does that do for you after tax? Well, you're in California, you're paying 37% capital gains tax. Plus, when I got into the weeds of his LOI, they were doing something clever. They were doing the transaction as a stock purchase, but they were treating it as an asset purchase for tax purposes. So I'm way too far in the weeds, but what did that mean? It means they could take their assets, because they had a lot of plant and equipment that was on the books at 2 or 3 million. They could write that back up to about $12 million. And what that did to him on the $30 million, it took 12 million of that 30 million and turned it into ordinary income in California. So of that 12 million, you have to pay 53% on, and then of the remaining 18 million, he'd pay capital gains on. So I said to him, I said, hey, you're going to net, you're giving up control, you're going to net 18 million after tax, something like that, right? We did the analysis. I said, I can sell 49% of your company for $25 million, get you 22 million at closing with 3 million as seller notes, and you're not going to pay any capital gains on the 25, and you're still going to own 51% of the company, and now wait 2 or 3 years and now sell to that private equity firm, and you've made out like a bandit, right? And what did he do? What do you think he did? He sold to private equity. And I said, why? And he said, well, he goes, in my space, and he was in an aging industry. He said, in my space, there's a couple of clients, he has some concentration risk, that he was significantly concerned 3, 4, 5 years later may go away. And so his concern was better to take money now. Now it's a funny thing, because I said to him, I said, what you should do is, because he was very much involved as the operator of this business, working 5, 6 days a week, 9, 10 hours a day. He didn't have to commute far. The company was, 20, 30 minutes from his home, but he was working really, really hard, and he'd been making good money for a number of years. And I said, do the ESOP, take the 25 million off the table, reinvest that, spend a little of your EBITDA to get your replacement in place. Maybe that's one person, maybe that's 2, but spend the next couple of years getting off the front lines. And this is good for any M&A transaction, because if the company's dependent on you, you're going to become an employee, which is what happened to him. And I just was with him and I said, how's that going? And I said, are you able to cut back? And he goes, no, I'm working harder than I ever have in my life. Right. And I understand his decision. And coming back to my point about working with entrepreneurs, that's their baby. That's their asset. Whatever they want to do with it, my job's to educate them. And when he called me up and he said, I sold a private equity versus doing the ESOP, you know what I said? Congratulations. Nobody gets hurt taking profit. You know, the difference in the millions isn't going to make a difference in his life at his stage, because he had a lot of resources outside of the business over, you know, running a successful business for many years. And, but I love people to explore. Hey, what does that path look like? Oh, now I know I've got that option. I've got another arrow in my quiver.
So here's what I think, Richard. If you get rid of all the noise, because there's so much benefits, there's so much but like at the end of the day, here's the way I look at it. Assuming that you're in an industry where strategics are not paying an inordinate premium to that of a financial buyer. So in layman's terms, your competitor, the Mr. Car Washes in the car wash space, the Whistle Expresses, they're not paying a higher multiple than a new private equity entrant who's acquiring a platform, which is indeed the case and correct right now in the car wash space, given the dynamics in the market. Then, putting that aside, when does an ESOP make sense? Makes sense to me from my limited knowledge that I'm vastly increasing every time I talk to you, and you're so gracious with sharing with me. It makes sense for you when you want to realize the value of your company and you want to do so in a manner where you care about the legacy and feel the legacy in the future of the company is better in the hands of the employees than it is a private equity sponsor.
And everybody knows kind of what happens when you sell to a private equity sponsor.
I have no idea what you're talking about. What would ever go wrong?
And I had a buddy of mine who was CEO of Bantam Doubleday Dell back in the 90s. And I just had lunch with him. He's 84 now, I guess. And when we were selling our company, he said to me, he goes, Richard, he goes, you know, I rolled up all these publishers and I would sit them across the room from me. And I said, you're going to get a really nice check. But once you cash that check, you've been bought. Life changes. You know, you're not the king, prince, queen, princess anymore, right? Now you're part of this other thing. And that was great advice back then. And it's still good advice now. I think that, you know, as somebody's preparing for their eventual exit, I love the idea of making sure the company can function without you, so that when you do end up rolled up into a private equity opportunity, that they're not dependent upon you, you know, so you've got your life and you've got the check. You don't have the same control, et cetera. But, you know, for this whole period of time, when you have an ESOP in place, even if you sell 100%, you know, the board that's in place when you do the transaction continues to govern. So the trustee is a directed trustee. They're not on the board. So even in the case, in some cases I have where 100% of the shares are owned by the ESOP trust, and the trustee is voting those shares for the interests of the employees. The board advises the trustee how to vote for the slate of directors each year, and the board can replace the trustee. So for all intents and purposes, this was one of the things that was a challenge to solve. Governance stays in place with the team that kind of created all the wealth. My metaphor is, you don't want the tight end all of a sudden calling plays for the football team, right? No. You know, the person that's great at whatever their specific job is likely not the person to truly understand all the variables involved in any particular business decision. So governance ends up staying in place. So anyone who has created, you know, I like to see, you know, I think the firm likes to see 3 to 5 million in earnings and profits or more, 10 million or more in revenue, 10 million more in revenue, because the banks will play. You know, when you're under 10 million in revenue, you know, once in a while I'll have a company 8 million in revenue and 4 million in profits. And it's still a more challenging capital raise, because it's a different caliber of banker that that plays in the under 10 million revenue space. So we like to see the 3 to 5 million of equity. Car wash space, to your point, it's a lucrative space. The financial buyers are paying high multiples, and the ESOP competes with those multiples. It's not like it almost competes. It competes dead on. If you've got LOIs and they're coming in at 10 or 12, your ESOP value is going to come in at 10 or 12 if all the other elements are supporting.
So here's where I'm at. I cannot believe where we are on time. I'm positive that we will get remarks saying that people want you back on. So we're going to have to continue this at some point, but I want to make sure that we hit a couple quick points before we do wrap up here for this episode, which is, so we talked about the minimum just now. I'm so glad you brought that up. That makes complete sense. Let me ask you a different question. What is too big?
The largest transactions we've done, my largest transaction enterprise value is about $1.8 billion right now. We sold 42% of the company for $510 million. And the owners took $510 million off the table. They were in California, got to defer their capital gains taxes, saved them $175 million in taxes, still own 58% of the company. They had a big division that they were thinking of selling off to private equity, which didn't happen. So I'm hopeful to take them from 42%, do another ESOP transaction, bring them up to about 75% or so, and then get them to be tax-free in California. California, as you can imagine, has a little wrinkle. You don't become 100% tax-free in California if you're 100% S Corp ESOP. You still have to pay 1.5% franchise tax fee, 1.5 points, which is still way down from 53 point whatever it is. Anyway, so that's what I'm hopeful there. We had an aerospace company where we did a public bond offering, and we sold 36% for $500 million. So it does scale quite large. I would say the clients we have with, right now I've got a couple of clients that are in that 600 million to $1 billion enterprise value. I've got 2 that I'm working on right now. I'm doing analysis for.
So, Richard, let it suffice to say, there's nobody in the car wash industry for which that is, even without getting into the theoreticals, that doesn't apply anyways. There's nobody who's listening to this and is a car
Nobody
wash.
That's too big. Nobody that's too big.
Exactly. And then what else have we absolutely not covered here that you think is paramount and essential for people to understand? Because this is going to be something that I know the average person who listens to it and is interested in it will listen to it multiple times because of just how much information was discussed. What did we not touch on that is absolutely pinnacle?
I think 2 things. A, it's essential to explore the opportunity. And B, the way that we love to do that is we enter into an engagement. We collect 5 years of historical financial information, a current tax return, some projections, as well as employee census information. And then we go off and we spend 3 weeks creating an analysis to show you the road ahead. Don't do anything. This is what it looks like going into the future. Here's a couple of leveraged optimized ESOPs. This is what we think the valuation range of your business is. Here's how much capital we think we can raise and at what rates. And if you like that road ahead, there's your toe in the water to explore that. And so if somebody's looking for liquidity and diversification, the one thing we didn't touch on at all in this conversation is there's also a whole host of estate planning elements related to this. And then there's even the opportunity when you do the ESOP to get it back into the next generation 20 years later. So it ends up 100% owned by the next generation. But those are variations on a theme. And I love to encourage folks to explore what it would actually mean for their business. And I'm happy to get on a call and I can do back of envelope things. But when we do our comprehensive analysis, it's 40, 50 page document. It becomes really, really clear. And the fun part that I have for folks in the car wash industry and other industries, as they're growing and they're expanding and doing things, I'm like, you're creating this equity, each $1 million of profits. If you can come up with this recurring model, you're creating in your space, it's $10 million in equity, right? It's floating around at 10x. So that's what I like to do. And then in the broadest sense, I just enjoy having conversations and working with entrepreneurs. It's something that's been part and parcel since I was wet behind the ears working at Cooper's back in the, I don't even want to say which year. It was 1978 is when I started with Cooper's and Lybrand, which, Harry, is probably before you were born.
1991. So I will tell you from my perspective, I have been quite literally, I wish I could say figuratively, but literally bashing my head against the wall now for 7 years in this space, meeting the most fantastic long-term business owners that have built incredible businesses, and they have zero intent to sell to private equity. And to me, this is beyond exciting because it's actually something that allows them to preserve their legacy when the time makes sense and to actually get the value you've built, for which otherwise there is no mechanism to do that, and leave it in the hands of your employees and the people that have built it with you. Right?
Great summary. And it's just, again, a joy to have been on today. I can't believe we burned an hour and we covered a lot of ground.
Here's what I'm thinking, Richard. Next episode, I think we're gonna have to do another one. It's gonna have to be on the financial benefits, because what we didn't do is and maybe we can get some graphics and stuff together. I'll help you. We can work on it, but we haven't gone through the fact that you're making way more money, all the flexibility that's provided with the proceeds. I mean, this is life-changing stuff.
What we'll do next time is I'll redact an actual analysis. We'll pick the right sized opportunity and we'll show you what that analysis looks like. And it's compelling. It's compelling. It's the best thing we do. And we'll touch on, what precise benefits are, and we'll pick something that's similar to, you'll tell me what size, and we'll dial something in.
That's a lot of freedom to give me. That sounds terrific, though. And Richard, before we kind of conclude here, how can people who want to find you find you?
Well, a couple things. I mean, if it's somebody who knows you, they can always text me, give you my cell number, which is 917-714-6437, 917-714-6437. Just say, hey, I saw you on Harry's podcast. Can we chat? And I'll give you my calendar. And then you can always reach me at rharmon, RHARMON, at CSG, CarlSamGeorgePartners.com, rharmon at CSGPartners.com. And I'll send you a link to some great learning materials and the like. We have some excellent digestible, meals related to this information that you can chew on at your own pace.
I've got one more thing that I'm going to kick myself if we don't bring up right now. Richard, for anybody who's evaluating offer in hand from a private equity or sponsor-backed group or strategic, is there any harm or foul from evaluating whether or not they're even paying you more than you would? I mean, in some...
It would be, we do this all the time, right? As a matter of fact, we joke that our favorite ESOP transactions have failed private equity transactions. Matter of fact, I just closed a large transaction that got right to the edge and fell apart for one reason or another. Why? Because the due diligence typically is not as intense. You've already seen everything go wrong in the other transaction, and then it's more of a breeze. But this is only ones that don't work out, Harry. And I know this is your ballywick, and you don't.
Oh, they don't all work out.
But when somebody's got that LOI in hand, this process takes 4 to 6 months. If they've got the LOI in hand, it's probably could be the same 4 to 6 months, depending on due diligence and the like. I think it's really valuable to explore what the option is, even if you've got a lean toward the private equity deal, because I don't know with my friend in the California company that was worth 50. I'll wait another year. I mean, this was just August when he closed this transaction of last year, and August of 2024 he closed with them, working harder than ever in 2025. I will talk to him again in 2026, and I'll say, okay, if you could flip the switch, what would you do? I do have a couple of friends who will say to me, Richard, before anybody does a private equity transaction, you have them call me first. But they have their place. It's wonderful the way the consolidation happens. However, there is some portion of the car wash industry where it's just a legacy play, and here's an elegant way to get liquidity, get diversification, get estate planning benefits, still set things up for the next generation, or set things up for your employees to run. And it's nice to know you have a different door to go through, as opposed to just one PE firm versus another PE firm, especially given all the tax benefits that have been put in place to inspire you to take a look.
I couldn't agree more. I'm so excited for the next episode. So this was scratching the surface, Richard. I cannot thank you enough for joining us. I know everybody's going to very much enjoy this. And once again, everybody, so this is Richard Harmon of CSG Partners. Richard, thank you so much for joining us. And please do tune in for our next episode.
Thank you, Harry.
Thanks, Richard.